say preparing the live streams, meetings being live streamed. Okay. Setting up your meeting for a live stream. Oh yeah, we do need to be doing this. I might need to do the meetings like this too. Now I think about it.
Hey, yeah, you know you can. The meeting. Okay, gotta click. Got it. All right, so we good to go. I don't know
Yeah,
why I had me click. Okay, like I guess because I'm another host, so
I think everybody got that.
Okay.
That messed me up. Let's see. Okay, so I got to redo this. All right. So, well, this gives everybody else that's going to be watching the recording an opportunity to see how I go about it. Okay. All right. We go to boost your product knowledge, and then we went to study by topic. All right. All right. So those terms was pretty straightforward. Key concepts and definitions. Insurance is a contract in which one party, the insurance company, agrees to, how you pronounce that word? Indemnify, which means make whole, the insured party against loss, damage, or liability arising from the unknown event. In life insurance, the policy protects survivors from losses suffered after an insured death. Insurance is a transfer of risk of loss from an individual or a business entity to an insurance company, which in turn spreads the cost of unexpected losses to many individuals. If there were no insurance mechanism, the cost of a loss would have to be borne solely by the individual who suffered the loss. Y'all see where it say know this. Insurance is the transfer of risk of loss. The cost of an insured's loss is transferred over to the insurer and spread amongst other insureds. The term insurance transaction include any of the following by mail or any other means: solicitation, negotiation, sale, effectuation of a contract of insurance, and advising an individual concerning coverage or claims. Now I got a question for y'all. Okay, so if there's a contract between the insured and the insurer, who has the biggest risk in that scenario between the insured and the insurer? Why you say the insurer?
Because if the you got the contract between those two, the individual, if the policy lapses or whatever, then they just won't receive coverage. But the insurer, if something goes wrong with that, then they tend to lose more with that individual and also financially.
That is good. That is good. So the insurer has the biggest risk. If you and the insurer agreed, you the insured agreed with the insurer to pay $50 a month for $300,000 of coverage. If something were to happen to you in an untimely demise, your $50 just bought $300,000 of coverage. So life insurance is just discounted money. So it's more of a risk on their end. All right. Types of insurers. All right. So this is the insurers, the companies that's actually insuring the people. Insurance companies can be classified in a variety of ways based on ownership, authority to transact business, location of incorporation, domicile, marketing and distribution systems, or rating, financial strength. All right. So these are how insurance companies are classified. All right. As you read about different classification of insurers, keep in mind that these categories are not mutually exclusive and the same company can be described based on where it is located and allowed to transact the business of insurance, who owns it, and what type of agents it appoints. Stock companies are owned by the stockholders who provide the capital necessary to establish and operate the insurance company and who share any in any profits or losses. All right, so stock companies are owned by the stockholders. That's pretty. That makes sense, right? Officers are elected by the stockholders and manage stock insurance companies. Traditionally, stock companies issue non-participating policies in which policy owners do not share in profits or losses. A non-participating stock policy does not pay dividends to policy owners. However, taxable dividends are paid to stockholders. The dividends are not guaranteed as they are based on company profit. On the other hand, you got mutual companies. Mutual companies are owned by the policy owners and issue participating policies. With participating policies, policy owners are entitled to dividends, which in the case of mutual companies are a return of excess premiums and are therefore non-taxable. Dividends are generated when the premiums and the earnings combined exceed the actual cost of providing coverage, creating a surplus. Dividends are not guaranteed. All right. So I got a question for y'all. Where does Primerica fit in? Stock company or mutual company?
Mutual company.
Mutual.
Okay, mutual.
Mm-hmm.
All right, Arkita.
Sorry, I'm cooking. But I'm saying it out loud, even though I'm not just leaving it unmuted. But yeah, I was thinking mutual as the same answer.
Okay, perfect. What make y'all say mutual company?
Well, one, because when you sit there and you invest, say you take from that policy, that company invests that difference from your initial investment and investment in mutual funds. So it helps your money to grow over time. And so they have certain mutual funds that they take and invest your money in, which allows your money to double or however, like I said, that mutual fund grows and allows you to see the growth of your money. So it's a mutual based company simply because it takes, say you invest $214, your policy is $85. It takes that difference from that and invest the rest into a mutual fund account.
Okay. Anybody want to add to that? Oh, that's pretty good.
I say because it's owned by the policyholders. It's not owned by the stock company, or so that's why it would be different. That's why it would be the mutual. Why we consider it, because your policyholder pretty much controls everything.
Okay. Good stuff. Anything else? All right. Those were some good feedbacks. I love this. So Primerica is actually a stock company. All right. It's a stock company. The reason being is because if you go to, which we'll do right now, if you go to this is what you do right here. Y'all see that? And we at 192. We killing them.
Oh, okay.
Y'all see that? So we're a stock company. Yep. I'm glad y'all said that. Yeah, we need this because this is how y'all learn. Now, let's go to State Farm. State Farm stock. So State Farm, if you notice, look at that. What does that say about State Farm?
Their growth fund. Oh, no, I'm looking at the wrong thing. Shares are not available to public market, to investors on the public market.
And
So
they're
they got
mutual
to pay State
insurance.
Farm in order to get it.
So what do that first sentence say?
It's a mutual insurance company. The fact that State Farm is a mutual insurance company
Yep.
means a company privately owned by the people who purchase its insurance policy.
Now, the reason why I stopped right here is because this is a real big piece, because you have different companies, different companies that actually, uh, look what this say. If y'all notice what this say, let's read the mutual company again. Mutual companies are owned by the policy owners and issue participating policies. With participating policies, policy owners are entitled. It didn't say they may, it said entitled to dividends, which in the case of mutual companies are a return of excess premiums. Do y'all know what that means?
So they're getting more money than they should.
They getting overcharged. Right.
Right. The insurance, I guess the policyholders are getting overcharged.
Exactly. So the
Oh,
person
so that's when they turn. Well, okay, not turn, but when they do the whole, like how you show us the breakdown when you're doing the presentation. So then when they taking that 9% and they ain't doing nothing, well, it's going back to the company, pretty much.
right. You see? And guess what? So you hear them say a lot. Yeah, that money that's built up in that cash value is non-taxable. Y'all see that?
Yeah.
The reason it's non-taxable when they get a dividend is because it's an excess of premium. It's a return of excess of premium. They're being overcharged.
It's a kickback.
And then where did this dividend come from? Dividends are generated when the premium
right
and the earnings combined exceed the actual cost of providing coverage, creating a surplus. Dividends are not guaranteed. Right? So that is how this works. So now they got a little short video that we're going to watch. So let's look at this.
Mrs. Smiley sent her teenage son Spencer to a grocery store. She gave him $40 and a list of things to buy. Spencer brought back the groceries and gave his mother back the money that he didn't use, $10 in change. If this was a mutual company, the $10 would be considered a dividend or a return of unused premium.
That was the best explanation. Did y'all catch that? Do we need to watch it again?
I caught it.
Y'all caught it?
I didn't, because I was making these turkey burgers. I'm sorry.
All right, you gonna be making all us turkey burgers. Who wants some turkey burgers?
I'll take some.
Give it up.
I got enough. I'm making homemade fries too with the green peppers and onions. Yeah.
Oh, see, I'm finna pull up.
I gotta make sure these kids when they get out of practice.
I got you. So check this out. So the mom gave the son $40 to get some groceries. All right. So the $40 to get groceries. So the $40 represent the premium paid. The groceries represent the requested coverage. All right. Which equal the policy features. All right. So that's the policy that they bought. So that's all the groceries that they bought. But then the dividends is the unused money. So if the son go to the grocery store and buy the groceries, but it was more money than what he had to spend, then he give his mom back the change. That's all the dividends is. That's unused premiums. So that was a phenomenal example. I like how they put that.
The change left over.
Right. The change left over. All right. Before insurers may transact business in a specific state, they must apply for and be granted a license or certificate of authority from the State Department of Insurance and meet any financial, in parentheses, capital and surplus requirements set by the state. So that means that the insurer, which is the company, has to be licensed in every state. And they have to meet the State Department of Insurance need. They got to meet those requirements that is set by the state. So each state will be different. Insurers who meet the state's financial requirements and are approved to transact business in the state are considered authorized or admitted into the state as a legal insurer. Those insurers who have not been approved to do business in the state are considered unauthorized or non-admitted. That's pretty simple, right? That's really, really simple. Most states have laws that prohibit unauthorized insurers from conducting business in the state except through licensed access and surplus lines brokers. All right. And so that's pretty simple. Pretty simple. We got to know this. Know this. Insurers must obtain a certificate of authority prior to transacting business in this state. That's what they just said, right? Okay. Domicile. How you say that? Is that domicile or domicile? Or am I saying both of it wrong? Somebody help me. Domicile. All right, domicile of insurer. Insurers can also be defined by their location of incorporation and whether or not they are authorized to write business in a state. All right. The insurer's domicile or location of incorporation. So that's what insurer's domicile means, location of incorporation. Will determine whether an insurance company is considered domestic, foreign, or alien. What is that? In the state they are incorporated in, they are considered a domestic insurer. Okay, so if they're in that state, they are domestic. All right. If the insurer is operating in a state other than the one they are incorporated in, they are called a foreign insurer. Okay. And then if the insurer is incorporated outside the United States, they are considered an alien insurer. Well, that's pretty straightforward, right? Pretty straightforward.
Yep.
Easy so far, right?
Yep.
All right. Contract law. A contract is an agreement between two or more parties enforceable by law. Because of unique aspects of insurance transactions, the general law of contracts had to be modified to fit the needs of insurance. Elements of a legal contract. In order for an insurance contract to be legally binding, they must have four essential elements. Agreement, which is offer and acceptance. So they got to have an agreement. That's offer. So they offer in $300,000 for $70. All right. And then you accept that, right? Consideration is they checking out your health and all of that good stuff. Competent parties. Okay. Who's the insured and who's the insurer? Who's the beneficiary, right? Who's the contingent, all that good stuff. And legal purpose. All right. What is the reason for this policy? Is it an insurability loss? I mean, financial loss? Is it, business? What is it? So now they about to go through it. Okay, there must be, so offer and acceptance. There must be a definite offer by one party and the other party must accept this offer in its exact terms. In insurance, the applicant usually makes the offer when submitting the application. Acceptance takes place when an insurer's underwriter approves the application and issues a policy. All right. So that the applicant makes the offer. Hey, will you accept me? Right. And then the company has the underwriter. And the underwriter is going to approve or disapprove, approve or decline the application. Consideration. The binding force in any contract is the consideration. Oh, the binding force in any contract is the consideration. Okay, what's that? Consideration is something of value that each party gives to the other. The consideration on the part of the insured is the payment of the premium. and the representations made by the application. The consideration on the part of the insurer is the promise to pay in the event of loss. Mm. Mm. Y'all get that? That makes sense,
Yes.
right? It say, know this, insurer's consideration is the promise to pay for losses. $75 for the $300,000. We promise to pay the $300,000. That is our consideration. The insurer's consideration is the payment of premium and statement on the application. My consideration is I will pay the $75 and everything on the application is true. Right? Well, I guess it didn't say that part. It just said statements on the application. That might be a test question. All right. Competent parties. The parties to a contract must be capable of entering into a contract in the eyes of the law. Generally, this requires that both parties be of legal age, mentally competent to understand the contract, and not under the influence of drugs and alcohol. Okay, so they got to be in a mental capacity. They got to be of legal age, which is 18, and mentally competent to understand the contract. All right. Now, legal purpose. The purpose of the contract must be legal and not against public policy. To ensure legal purpose of a life insurance policy, for example, it must have both. Insurable interest and consent. This is why you just can't write policies on anybody. A contract without a legal purpose is considered void and cannot be enforced by any party. So when people be like, can I put a policy on my neighbor? There's no insurability interest. There's no insurable interest. All right. So it got to be a reason for that. Distinct characteristics of an insurance contract. All right. Contract of adhesion. A contract of adhesion is prepared by one of the parties, insurer, and accepted or rejected by the other party, insured. Insurance policies are not drawn up through negotiations. Y'all get that? There's no negotiation. Well, I got $75. Can I get $350 instead of $300? No, we can't do that. Not with insurance policies. All right. So insurance policies are not drawn up through negotiations, and an insured has little to say about its provision. In other words, insurance contracts are offered on a take it or leave it basis by insurer. Any ambiguities in the contract will be settled in favor of the insured. Aleatory contract. Insurance contracts are aleatory, which means there is an exchange of unequal amounts or values. The premium paid by the insured is small in relation to the amount that will be paid by the insured in the event of loss. Ain't that what we just talked about?
Mm-hmm.
Right? That's exactly what we just talked about. Life and health example. John purchases a life insurance policy for $100,000. His monthly premium is $100. If John only had the policy for 2 months, which means he only paid $200 in premium, and he unexpectedly died, his beneficiary will receive $100,000, a $200 contribution. $200 contribution on the part of the insurer in exchange for $100,000 benefit from the insurer illustrates an aleatory contract. All right. So we're buying. So when people buy life insurance, they're really buying a discounted dollars. That's really what it is. But that is aleatory. All right. Property and casualty example. John purchases a homeowner's insurance policy for $100,000. His monthly premium is $100. If John only had the policy for 2 months, which means he only paid $200 in premium, and the home was unexpectedly destroyed by a covered peril, John will receive $100,000. A $200 contribution on the part of the insured in exchange for a $100,000 benefit from the insurer illustrates an aleatory contract. This is why we talk to people about life insurance, right? Because they taking little dollars to get big dollars when in an unexpected timely demise. So aleatory is uneven exchange of values. That's all it is. All right, so let's look at this real quick.
An insurance contract is aleatory in nature, which means there is an uneven exchange of values. For instance, Bob purchases a $75,000 whole life policy in January. His monthly premium is $100. In March, after paying only 2 months' premium, or $200 total, he is tragically killed in a skiing accident. Bob's beneficiary will receive $75,000, a mere $200 in exchange for $75,000. That's definitely not equal.
Dadgummit, somebody should have switched Bob over to term. All right. All right. Unilateral contract, if I'm saying that correctly. Or unlateral,
You said it
unilateral.
right the first time, unilateral.
All right. In a unilateral contract, only one of the parties to the contract is legally bound to do anything. The insured makes no legally binding promises. However, an insurer is legally bound to pay losses covered by a policy in force. All right, so now let's look at this.
Barney and Wilma own a $350,000 life insurance policy. When Barney unexpectedly loses his job, they are forced to cancel that policy. Barney and Wilma notify the insurance company and request their policy to be canceled. The insurance company may not file legal actions against Barney and Wilma for canceling the policy. On the flip side, let's assume that Barney and Wilma continue their policy in force and make premium payments. When Barney is suddenly killed in a hunting accident, the company cannot simply refuse to pay the death benefit. As long as the premiums are current, the named beneficiary has legal recourse if the company refuses to pay the death benefit.
All right. So do y'all see so far, this is actually in the benefit for the insured. Right?
Yeah, you can see it.
Because the company cannot just up and just cancel you. Like, nope, they can't do that. That is good. Conditional contract. This is a good one. As the name implies, a conditional contract requires that certain conditions must be met by the policy owner and the company in order for the contract to be executed and before each party fulfills its obligations. All right. For example, the insured must pay the premium and provide proof of loss in order for the insurer to cover a claim. Representation and warranties. A warranty is an absolute true statement upon which the validity of the insurance policy depends. Breach of warranties can be considered grounds for voiding the policy or a return of premium. Because of such a strict definition, statements made by applicants for life and health insurance policies, for example, are usually not considered warranties except in cases of fraud. All right. Representations. Representations are statements believed to be true to the best of one's knowledge, but they are not guaranteed to be true. For insurance purposes, representations are the answers the insured gives to the questions on the insurance application. Untrue statements on the applications are considered misrepresentations and could void the contract. A material representation is a statement that, if discovered, will alter the underwriting decision of the insurance company. Furthermore, if material misrepresentation are intentional, they are considered fraud. So we got quite a few vocabulary words in there that we want to be careful of, because that's definitely a test question. They're going to try to trip you up between a warranty and representative. So let's look at this short video.
As part of the application process for his new life insurance policy, Herman needed to answer an extensive list of questions about his medical history. When asked if he had ever been treated for or diagnosed with any form of cancer or tumor, he truthfully answered no. Herman was accepted as a standard risk and the policy was issued. 2 weeks later, during a routine doctor's exam, it was discovered that he had an advanced form of cancer. The insurance policy will remain in place since Herman's answer on the insurance application regarding cancer would be perfectly acceptable as a representation and not a warranty.
Y'all get that?
Yeah.
Because he didn't know he had cancer until after the fact, right? When he got
Right.
diagnosed with it. Yeah, so it's a representation.
Right. Yep, that is good. That is good. All right, so make sure y'all know that, because they will try and trip you up between warranties and representations.
Mm-hmm.
All right. So a warranty, I would assume a warranty is something like your age. That's a warranty, right? Is an absolute true statement, right? So that would be that's definitely a warranty. Your age, height, something like that. Name.
Didn't they have something on here where if the person, they had said one age, and then once they passed, they found out they were a different age, but in the clause, they would just end up making the adjustable to the age that the person was. I read
Yes,
something about that.
and that's a good question. That would become a problem, like if that individual passed away within 2 years.
Because it's 3 years actually for it to be legal, in so many words, right?
2.
Oh, so
Now,
okay.
yeah, I would say make sure I think that's in every state it's 2 years. 2 years. And I'm sure they're gonna bring that up in this chapter. Contestability. That's what it's called. That's contestability. All right. So notice this representations are statements believed to be true. Insured statements on the application are representations. All right. So insured statements. So when you ask them medical questions and stuff like that, that's representations. All right. Completing the application. The application is the starting point and basic source of information used by the insurance company. Used by the company in the risk selection process. Although applications are not uniform and may vary from one insurer to another, they all have the same basic components. Part 1, which is general information, and part 2, which is medical information. Now, if you have sat in a presentation with us, right, and we ended up writing up a policy, you notice that is true. They got the general information, your age, your full name, address, social security numbers, driver's license, all of that. And then on the back end, they go through the medical information. General information of the application include the general questions about the applications, just what I just said: name, address, age, birthday, gender, income, marital status, and occupation. It will also inquire about the existing policies and if the proposed insurance will replace them. All right. Part 1 identifies the type of policy applied for and the amount of coverage, and usually contains information concerning the beneficiary. Part 2, medical information of the application includes information on the prospective insurer's medical background, present health, any medical visits in recent years, medical status of living relatives, and causes of death of deceased relatives. If the amount of insurance is relatively small, the agent and the proposed insured will complete all of the medical information. That will be considered a non-medical application, right? So that's like with Primerica, when we do a $300,000 policy on a person, that's the most coverage a person can get without the medical testing. For larger amounts, the insurer will usually require some sort of medical examination by a professional. So anything over 300,000, depending on the age, if they 45 or younger, I believe it is, you can get a $300,000 policy without any medical records. And 150,000 if you are 50 or 55 or older. All right. It is the agent's responsibility to make certain that it's the agent's responsibility to make certain that the application is filled out completely, correctly, and to the best of the applicant's knowledge. The agent must probe beyond the stated questions in the application if he or she has any reason to believe the applicant is misrepresenting or concealing information or does not understand the specific questions asked. Any information that is misleading, inaccurate, or illegible may delay the issuance of the policy. If the agent feels that there could be some misrepresentation, he or she must inform the insurance company. Some insurers require that the applicant complete the application under the agent's watchful eye, while other insurers require that the agent complete the application in order to help avoid mistakes and unanswered questions. We kind of do both.
Yeah, just like when they came when they did a medical exam or whatever, when I fill out the application, they sent the nurse or whatever out. Plus the agent was here, they checked my blood pressure, they checked everything else that I needed. And then also, did a urine screen and all that other kind of stuff, but they made sure that they were there to make sure everything lined up the way it was supposed to be.
Right. That's good. So the agent that will be considered us is the company's front line and is referred to as a field underwriter because the agent is usually the one who has solicited the potential insured. As a field underwriter, the agent has many important responsibilities during the underwriting process and beyond, including the following: proper solicitation of applicants, helping prevent adverse selection, completing the application, obtaining the required signature, collecting the initial premium, and issuing the receipt, if applicable, and delivering the policy. Know this: a life insurance producer is the company's field underwriter. That's pretty easy. So that's all of us, right? We are the field underwriter. Well, once you license, you're the field underwriter. As a field underwriter, the agent or producer can be considered the most important source of information available to the company underwriters. So we are the most important information available. And the reason being is because we're actually looking at the person, we're dialoguing with the person. The agent's producer's report provides the agent's personal observation concerning the proposed insured. The insurer may inquire whether the agent knows of any adverse information about the applicant, or ask the agent to express an opinion about the applicant's character, financial standing, and environment. The agent's report does not become a part of the entire contract, although it is a part of the application process. Required signatures. Both the agent and the proposed insured, usually the applicant, must sign the application. If the proposed insured and the policy owner are not the same person, such as a business purchasing insurance on an employee, then the policy owner must also sign the application. So that could be 3 signatures. An exception to the proposed insured signing the application would be in the case of an adult, such as a parent or a guardian, applying for insurance on a minor child. That makes sense, right? The kids ain't got to sign. They children, they minors. Changes in the application. When an answer to a question on the application needs to be corrected, agents have the option, depending on which insurer they represent, of correcting the information and having the applicant initial the change or completing a new application. An agent should never erase or white out any information on application for insurance. Well, we ain't got to worry about that piece, right? Because it's all online. Consequences of incomplete application. Before a policy is issued, all of the questions on the application must be answered. If the insurer receives an incomplete application, the insurer must return it to the applicant for completion. If a policy is issued with questions left unanswered, the contract will be interpreted as if the insurer waived its right to have an answer to the question. The insurer will not have the right to deny coverage based on any information that the unanswered question might have contained. That's something that we don't have to worry about either, because it will let you know you got an unanswered question. All right. Consequences of incomplete application. Oh, no, we read that. Hold on.
You on collecting the initial premium and issuing a receipt.
There we go. All right. Collecting the initial premium and issuing the receipt. Most agents attempt to collect the initial premium and submit it along with the application to the insurer. In addition, collecting the initial premium at the time of the application increases the chances that the applicant will accept the policy once it is issued. Whenever the agent collects premiums, the agent must issue a premium receipt. The type of receipt issued will determine when coverage will be effective. The most common type of receipt is a conditional receipt, which is used only when the applicant submits a prepaid application. The conditional receipt says that the coverage will be effective either on the date of the application or the date of the medical exam, whichever occurs last, as long as the applicant is found to be insurable as a standard risk and policy is issued exactly as applied for. This rule will not apply if a policy is declined, rated, or issued with riders excluding specific coverages. So an example, if an agent collects the initial premium from an applicant and gives the applicant a conditional receipt and the applicant dies the next day, the underwriting process will process as though the applicant were still alive. If the insurer ends up approving the coverage, then the applicant's beneficiary will receive the death benefit of the policy. If, on the other hand, the insurer determines that the applicant was not an acceptable risk and declines the coverage, the premium will be refunded to the beneficiary, and the insurer is not required to pay the death benefit. All right. So now we got a small video on that.
Jeff applies for life insurance on February 2nd. He pays the required premium and accepts a conditional receipt. Unfortunately, 3 days later, Jeff is killed in a car accident. On February 10th, the underwriter accepts Jeff's life application on a standard basis and issues a policy. Even though Jeff is already deceased, the company will pay the death benefit to the beneficiary because the legal contract is in force. Now, what if the underwriter did not accept Jeff's application due to a possible health risk? The agent may still attempt to deliver a policy that offers a different amount of coverage and benefits than those applied for. He must, however, inform the beneficiary that there is no coverage in force, and thus no death benefit will be paid.
All right. So I actually had this happen in my case where an individual passed away while the policy was in review. And the gentleman, unfortunately, did not sign. There was a document that Primerica wanted him to sign to get his medical records, but he did not get that over to them. And because of that, unfortunately, we did not pay that out. And so the company is real good. They hire people to make sure that, the actuaries to make sure that, their risk is to a minimum. So the reason they wanted that signature was the same reason the gentleman unfortunately passed away. All right. So that's why we be on it. So especially with policies that even the ones companies Arquita, so we gotta get with your friend, right? It say it issued with requirements. We got to get that situated, because if something were to happen, now we putting it at the mercy of the company, and we do not want to do that.
You said we got to get with.
Your girl Jolie.
Oh, okay.
Yep. All right, so that's good. All right. Know this: conditional receipt means the applicant must be covered as early as the date of the application. All right. Replacement. Replacement is a practice of terminating an existing policy or letting it lapse. And obtaining a new one. All right. So if they let a policy lapse and then they get a new one, they replaced it. To make sure that replacement is appropriate and is the best interest of the policy owner, insurance producers and companies must take special underwriting measures to help policy owners make informed decisions. Underwriting. Underwriting is the risk selection process. All right. The underwriter's responsibility include selecting only those risks that are considered insurable and meet the insurer's underwriting standards. The purpose of underwriting is to protect the insurer against adverse selection, risks which are more likely to suffer a loss. The primary criteria an underwriter will use in assessing the desirability of a particular candidate for life insurance includes the applicant's health, current and past, occupation, lifestyle, and hobbies or habits. The underwriter will use many different sources of information in determining the insurability of the individual risk. The specific underwriting requirements will also differ by insurers. Insurable interest. We talked about this earlier. To purchase insurance, the policy owner must face the possibility of losing money or something of value in the event of a loss. This is called insurable interest. In life insurance, insurable interest must exist between the policy owner and the insurer at the time of application. However, once the life application Once a life insurance policy has been issued, the insurer must pay the policy benefit whether or not an insurable interest exists. A valid insurable interest may exist between the policy owner and the insured when the policy is insuring any of the following: policy owner's own life, right? The life of a family member, a spouse, or a close blood relative, or the life of a business partner, key employee, or someone who has financial obligation to the policy owner. For example, a debtor has a financial obligation to a creditor, so the creditor has a valid insurance interest in the life of the debtor. Insurable interest is not required of beneficiaries. Since the beneficiary's well-being is dependent upon the insured, and the beneficiary's life is not the one being insured, the beneficiary does not have to show an insurable interest for a policy to be purchased. All right. So we don't even, look at the beneficiary as far as their health or anything like that. Know this: insurable interest must exist at the time of application. That's pretty simple, right? Know this: the policy owner must have insurable interest in the life of the insured. All right. So that's good. That's good. Sources of underwriting information. In order to properly select and classify insurance risk, the insurer needs to obtain the applicant's background information and medical history. There are several sources of underwriting information that are available to underwriters. Application. The person applying for insurance must submit an application to the insurer for approval for a policy to be issued. The application is one of the main sources of underwriting information for the company. Know this: an insurance application is the key source underwriters use for information about the applicant. So that is the key source that underwriters use to gain information on the applicant. Agent's report. The agent's report allows the agent to communicate with the underwriter and provide information about the applicant known by the agent that may assist in the underwriting process. Investigative consumer report. This is the inspection. To supplement the information on the application, the underwriter may order an inspection report on the applicant from an independent investigating firm or credit agency, which covers financial and moral information. They are general reports of the applicant's finances, character, work, hobby, and habits. Companies that use inspection reports are subject to the rules and regulations outlined in the Fair Credit Act. What is the Fair Credit Reporting Act? Procedures that consumer reporting agencies must follow.
All right, I'll be right back.
What you say?
Oh no, I didn't mean that. I went. I'm heading out to go get the kids, so I have to jump on my phone and get off the computer.
Okay.
No, but I'm still on. I'm just moving around. That's all.
Okay, cool. So the Fair Credit Reporting Act established procedures that consumer reporting agencies must follow in order to ensure that records are confidential, accurate, relevant, and properly used. The law also protects consumers against the circulation of inaccurate or obsolete personal or financial information. The acceptability of a risk is determined by checking the individual risk against many factors directly related to the risk potential for loss. Besides these factors, an underwriter will sometimes request additional information about a particular risk from an outside source. These reports generally fall into two categories: consumer reports and investigative consumer reports. Both reports can only be used by someone with a legitimate business purpose, including insurance underwriting, employment screening, and credit transactions. Consumer reports include written and or oral information regarding a consumer's credit, character, reputation, or habits collected by a reporting agency from employment records, credit reports, and other public sources. Investigative consumer reports are similar to consumer reports in that they also provide information on the consumer's character, reputation, and habits. The primary difference is that the information is obtained through the investigation and interviews with associates, friends, and neighbors of the consumer. Unlike consumer reports, these reports cannot be made unless the consumer is advised in writing about the report within 3 days of the date the report was requested. The consumers must be advised that they have a right to request additional information concerning the report, and the insurer or reporting agency has 5 days to provide the consumer with the additional information. Know this: insurance applicants must be notified in writing whenever insurers request investigative consumer reports. All right, let's look at the little video.
When Bob, an insurance agent, received a life policy application from Mr. Z, he felt that Mr. Z was not completely honest in providing information necessary for proper underwriting and risk classification. To obtain more information on Mr. Z's character and life habits, Bob requested an investigative consumer report. The following day, he notified Mr. Z of his actions. The results of interviews with Mr. Z's associates and neighbors showed that he was not eligible for requested coverage. Bob informed Mr. Z of the reasons for denial of coverage and provided him with the name and address of the reporting agency.
All right. All right. Pretty self-explanatory.
So basically, if you, excuse me, so basically, if you feel someone is misrepresenting or you might think something is wrong, you can request that investigative consumer report.
Correct.
Okay.
Correct. That is good. That is good. All right. The reporting agency and users of the information are subject to civil action for failure to comply with the provision of the Fair Credit Reporting Act. A person who knowingly and willfully obtain information on the consumer from a consumer reporting agency under false pretense may also be fined and or imprisoned for up to 2 years. That's a big deal. An individual who unknowingly violates the Fair Credit Reporting Act is liable in the amount equal to the loss of the consumer, as well as any reasonable attorney fees incurred in the process. An individual who willfully violates this act enough to constitute a general pattern or business practice will be subject to a penalty of up to $2,500. Dadgummit. Under the Fair Credit Reporting Act, if a policy of insurance is declined or modified because of information contained in either a consumer or investigative report, the consumer must be advised and provided with the name and address of the reporting agency. The consumer has the right to know what was in the report. The consumer also has a right to know the identity of anyone who has received a copy of the report during the past year. If the consumer challenges any of the information in the report, the reporting agency is required to re-investigate and amend the report. All right, if warranted. If a report is found to be inaccurate and is corrected, the agency must send the corrected information to all parties to which they had reported the inaccurate information within the last 2 years. Consumer reports cannot contain certain types of information if the report is requested in connection with the life insurance policy or credit transaction of less than $150,000. All right, so they can't contain certain types of information. All right. The prohibited information includes bankruptcies more than 10 years old, civil suits, records of arrest or conviction of crimes, or any other negative information that is more than 7 years old. As defined by the Act, negative information includes information regarding the consumer's delinquencies, late payments, insolvencies, or any other form of default. Then you got the good old Medical Information Bureau, MIB. In addition to attending physician's report, the underwriter will usually request a Medical Information Bureau, MIB for short, report. MIB is a membership corporation owned by member insurance companies. It is a nonprofit trade organization, the purpose of which it is to collect, maintain, and make available to insurance companies important underwriting information on applicants for life and health insurance. It is a systematic method for companies to compare the information they have collected on a potential insurer with the information other insurers may have discovered. The MIB can be used only as an aid in helping insurers know what areas impairment they might need to investigate further. An applicant cannot be refused simply because of some adverse information discovered through the MIB. So what happens if they do find out some adverse information, they end up wanting medical records. This is why we ask people to answer the application truthfully to the best of their ability, because it's going to come out. Right? It's going to come out. And they be thinking that the insurance companies can't see that stuff, and they actually can. All right, know this. Insurers cannot refuse coverage solely on the basis of adverse information on the MIB report. So they can't decline somebody because of this report. Now, it can raise some questions and raise some awareness where they, do they due diligence, but they can't just decline somebody. All right, medical examinations. For policies with higher amounts of coverage, or if the application raised additional questions concerning the prospective insured health, the underwriter may require a medical examination of the insured. There are two options, depending on the reason for the medical examination. The insurer may only request a paramedical report, which is completed by a paramedic or registered nurse, and the underwriter may require an attending physician statement, APS. When y'all start writing policies, y'all will see that a lot, APS. Right, that's attending physician statement from a medical practitioner who treated the applicant for prior medical problem. Medical examination, when required by the insurance company, are conducted by physicians or paramedics at the insurance company's expense. Usually, such exams are not required with regard to health insurance, thus stressing the importance of the agent in recording medical information on the application. The medical exam requirement is more common with life insurance underwriting. If an insurer requests a medical examination, the insurer is responsible for the cost of the exam. It is common among insurers to require an HIV test, when an applicant is applying for a large amount of coverage or for any increase and additional benefits. To ensure proper obtaining and handling of results, and to protect the insurer's privacy when an insurer requires an applicant to submit an HIV test, they must do the following: disclose the use of testing to the applicant and obtain written consent from the applicant on the approved form. Establish written policies and procedures for the internal dissemination of the test results among its producers and employees to assure confidentiality. Then you got good old HIPAA, right? So the Health Insurance Portability and Accountability Act, HIPAA, is a federal law that protects health information. HIPAA regulations provide protection for the privacy of certain individually identifiable health information, such as demographic data that relates to physical or mental health conditions, or payment information that can identify the individual, referred to as protected health information. Under the privacy rule, patients have the right to view their own medical records, as well as the right to know who has accessed those records over the previous 6 years. All right. The privacy rule, however, allows disclosure without individual authorization to public health authorities authorized by law to collect or receive the information for the purpose of preventing or controlling disease, injury, or disability. So y'all know at the end where it has all those the signatures, and do y'all remember seeing HIPAA?
Yes,
Right?
Yeah, I remember.
right.
Right. So now when y'all see on the application, when we're doing like life policies, you'll see at the very end all of this stuff that it's talking about, these different signatures. All right. Use and disclosure of insurance information. Every applicant for a life insurance policy must be given a written disclosure statement that provides basic information about the cost and coverage of the insurance being solicited. All right, so those are disclosures I was just talking about. This disclosure statement must be given to the applicant no later than the time the application for insurance is signed. Disclosure statements will help the applicants to make more informed and educated decisions about their choice of insurance. When insurers plan to seek and use information from investigators, they must first provide the applicant insured with a written disclosure authorization notice. It will state the insurer's practice regarding collection and use of personal information. So that's the information at the very end when they doing the signature. The disclosure authorization form must be written in plain language and must be approved by the head of the Department of Insurance. Risk classification. All right. And classifying the risk, the Home Office underwriting department will look at the applicant's past medical history, present physical condition, occupation, habits, and morals. If the applicant is acceptable, who is this with this music? Y'all hear that? If the applicant, somebody just in a parking lot. All right. If the applicant is acceptable, the insurer must then determine the risk or rating classification. So this determines if they're going to pay a higher or lower premium. All right. So they may be classified as standard, substandard, or preferred. Which one y'all think is like the best one, the best rating?
Preferred.
Preferred. Which one is the not so best rating?
Substandard.
Substandard. Yep. So preferred risk, they meet certain qualifications and they get lower premiums than the standard risk. All right. These applicants have superior physical condition, lifestyle, and habits. Then standard risks are person who, according to the company's underwriting standards, are entitled to insurance protection without extra rating or special restrictions. So they normal. All right, they pretty normal. They have average risk. Then you got the substandard high exposure risk. These are applicants that are not acceptable at standard rates because of physical condition, personal or family history of disease, occupation, or dangerous habits. So these policies are referred to as rated. They also known as rated with a higher policy. So the premium is rated up. That's a good way to think about it. Rated up. If you get a policy that's rated up, that means that got higher premium. Applicants who are rejected are considered declined risk. All right, decline risk that the underwriting assess as not insurable are declined. So they may be declined because there's no insurable interest. I want to put a policy on my next door neighbor. They're like, no, that's not going to work. The applicant is medically unacceptable. The potential for loss is so great it does not meet the definition of insurance, or insurance is prohibited by public policy or is illegal. All right. Any questions on that?
No, I don't have any.
All right, we are almost done. We right there. This is the last little part right here. Whole time. Hey, Gummy, y'all still there? Everybody still there?
You still holding on, brother.
Yep.
That's what I'm talking about. That's what I'm talking about.
I'm here.
That's what I'm talking about. Did we get any new people? Anybody else?
Nah, and then like I said, I had to come off the computer because I had to come pick up the kids from practice. So I don't know if the host thing followed me or not, co-hosting, but I didn't see nobody. Like I checked before I left, but nobody.
Okay.
I was the only one because I had to switch over to my phone.
Okay, we should be good. Let me see. We should be good. Hold on 1 second. Yeah. I think you still co-host. Oh no, you're not.
Okay.
You're not. I mean, let me see. All right. Okay. All right. We almost done. All right.
All right.
Here we go. So the last one is, what is this? This is stranger oriented life insurance. This is STOLI, an investor originated life insurance. Ali. So stranger-oriented life insurance, STOLI, is a life insurance arrangement in which a person with no relationship to the insured, a stranger, purchases a life policy on the insured's life with the intent of selling the policy to an investor and profiting financially when the insured dies. In other words, STOLIs are financed and purchased solely with the intent of selling them for life settlements.
Right, that's what you just was talking about the insured, get insured on the neighbor.
Right. And here we go. STOLIs violate the principle of insurable interest, which is in place to ensure that a person purchasing a life insurance policy is actually interested in the longevity rather than the death of the insured. Because of this, insurers take an aggressive legal stance against policies they expect are involved in STOLI transactions. Note that lawful life settlement contracts do not constitute STOLIs. So this is illegal. Life settlement transactions result from existing life insurance policies. STOLIs are initiated for the purpose of attaining a policy that will benefit a person who has no insurability interest in the life of the insured at the time of a policy or origination. All right. Now we got the investor's own life insurance. OLI or Ali is another name for a STOLI, so it's almost the same, where a third-party investor who has no insurable interest in the insured initiates a transaction designed to transfer the policy ownership rights to someone with no insurable interest in the insured and who hopes to make a profit upon the death of the insured or annuitant. So this is a little chart they got. Stoli, buying a new policy on a stranger, no insurability interest, no insurable interest. Life settlement, selling an insurance, selling an existing life policy. Yeah, selling an existing life insurance policy. All right, so yep, we want to be on the lookout for those. Primerica don't even allow an individual to get away with that type of stuff. They have to really lie on the application. Delivering the policy. Once the underwriting process has been completed and the company issues the policy, the agent will deliver to the insured. Although personal delivery of the insurance policy is the best method of finalizing the insurance transaction, mailing the policy directly to the policy owner is acceptable. When the insured relinquishes control of the policy by mailing it to the policy owner, policy is considered legally delivered. However, it is advisable to obtain a signed delivery receipt. Explaining a policy and its provisions, riders, exclusions, and ratings. Personal delivery of the policy allows the agent an opportunity to make sure that the insured understands all aspects of the contract. Review the contract with the insured involves pointing out provisions or riders that may be different than anticipated and explaining what effect they have on the contract. In addition, the agent should explain the rating procedure to the client, especially if the policy is rated differently than applied for or has been modified or amended in any other way. The agent should also explain any other choices and provisions available to the policy owner that may become active at this time. A buyer's guide provides basic generic information about insurance, life insurance policies that contains and is limited to language approved by the Department of Insurance. This document explains how a buyer should go about choosing the amount and type of insurance to buy and how a buyer can save money by comparing the cost of similar policies. Insurers must provide a buyer's guide to all prospective policy applicants prior to accepting their initial premium. If the policy contains an unconditional refund provision of at least 10 days, which is the free look period, a buyer's guide can be delivered with the policy. Policy summary is a written statement describing features and elements of the policy being issued. It must include the name and address of the agent, the full name and home office or administrative office address of the insurer, and the generic name of the basic policy and each rider. A policy summary will also include premium, cash value, dividend, surrender value, and death benefit figures for specific policy years. The policy summary must be provided when the policy is delivered. Now, this is one of the things that we look for in a policy. What's the policy summary? Because they have all of these different things that we need to get, right? They have all of those different things: premium, cash value, dividends, surrender value, all of that, death benefit. All right, so we need that. Know this: a buyer's guide provides generic information on various types of policies. A policy summary provides specified or specific information on the policy being issued. The term illustration means a presentation or depiction that includes non-guaranteed elements of a policy or of individual or group life insurance over a period of years. A life insurance illustration must do the following: distinguish between guaranteed and projected amounts, clearly state that an illustration is not a part of the contract, and identify those values that are not guaranteed as such. All right. This is something that agents get, whole life agents get people with all the time. Distinguish between guaranteed and projected amounts. Right? They do not clearly state that illustration is not a part of the contract. So these are things, when you're going on appointments and we're looking at people's policies, you can kind of see this. All right. An agent may only use the illustration of the insured that have been approved and may not change them in any way. When coverage begins, if the initial premium is not paid with the application, the agent will be required to collect the premium at the time of the policy of delivery. In this case, the policy does not go into effect until the premium has been collected. The agent may also be required to get a statement of good health from the insured. This statement must be signed by the insured and verifies that the insured has not suffered injury or illness since the application date. If the full premium was submitted with the application and the policy was issued as requested, the policy coverage would generally coincide with the date of the application if no medical exam were required. If a medical exam is required, the date of the coverage will coincide with the date of the exam. Know this, no premium, no coverage. Do everybody understand that? No premium, no coverage.
Yeah, I got it.
Right.
Application completed and signed. Was premium received at the time of application? And then they got this. So if it's yes, was policy issued? Yes. Then start of coverage, date of application. All right, this is important. So date of application. All right. Now, was premium received at the time of application? No. Was policy issued? Yes. Collect at delivery, premium, statement of good health. Then the start of coverage is date of delivery. All right. So notice when the policy, when the premium is paid, that's normally when the policy starts the coverage. Got to be a transaction. All right. And then they got, let's see, what's all of this? They got privacy protection. I've never really seen this. Gramm-Leach Blindly Act. The Gramm-Leach Blindly Act stipulates that in general, an insurance company may not disclose non-public personal information to a non-affiliated third party except for the following reasons. The insurance company clearly and suspiciously discloses to the consumer in writing that information may be disclosed to a third party. The consumer is given the opportunity before the time that the information is initially disclosed to direct that information not be disclosed to the third party, disclosed to the third party, or the consumer is given an explanation of how the consumer can exercise a non-disclosure option. The Gramm-Leach Blindly Act requires two disclosures to a customer who has an ongoing financial relationship with the financial institution. One, when the consumer relationship is established, so policy is purchased, and two, before disclosing protected information. The customer must also receive an annual privacy disclosure and have the right to opt out or choose to not have their private information shared with other parties. And you got USA Patriot Act and money laundering, anti-money laundering. So the uniting and strengthening American by providing appropriate tools required to intercept and obstruct terrorism act, also known as the USA Patriot Act, was enacted on October 26, 2001. The purpose of the act is to address social, economic, and global initiatives to fight and prevent terrorist activities. The act enabled the Financial Crime Enforcement Network, FinCEN, to require banks, broker-dealers, and other financial institutions to establish new anti-money laundering standards. With new rules in place, FinCEN incorporated the insurance industry into this group. To secure the goals of the act, FinCEN had implemented an AML program that requires the monitoring of all financial transactions and reporting of any suspicious activity to the government, along with prohibiting correspondent accounts with foreign shell banks. A comprehensive customer identification and verification procedure is also to be set in place. The AML anti-money laundering program consists of the following minimum requirements: assimilate policies, procedures, and internal controls based on an in-house risk assessment, including instituting AML programs similar to banks and securities lenders, and file suspicious activity reports, SAR, with federal authorities. Appointed a qualified compliance officer responsible for administering the AML program. Continual training for applicable employees, producers, and other, and allow for independent testing of the program on a regular basis. So, yeah, that's for people that's trying to do money laundering, and that's probably prevalent in them whole life policies, right? Then, last but not least, suspicious activity reports, SAR rules. Any company that is in subject to the AML program is also subject to SAR rules. SAR rules state that the procedures and plans must be in place and designed to identify activity that one would deem suspicious of money laundering, terrorist financing, and or other illegal activities. Deposit, withdrawals, transfers, or any other business deals involving $5,000 or more are required to be reported if the financial company or insured knows, suspects, or has reason to suspect that the transaction has no business or lawful purpose, is designed to deliberately misstate other reporting constraints, uses the financial institution or insurer to assist in criminal activity, is obtained using fraudulent funds from illegal activities, or is intended to make funds from other illegal activities. Some red flags to look for: customer use fake IDs or changes a transaction after learning that he or she must show ID. 2 or more customers use similar IDs. Customer conducts transactions so that they fall just below amounts that require reporting or record keeping. 2 or more customers seem to be working together to break one transaction into 2 or more, trying to invade the bank. Secretary Acts, BSA requirements. And that is it. Relevant SAR reports must be filed with FinCEN within 30 days of initial discoveries. Reporting takes place on FinCEN Form 108. Then they got the chapter review, right? All of this good stuff. But this first chapter was pretty self-explanatory, right? It's pretty straightforward. All right, and it's the last video they got.
That was a lot of information, but you made it through. Congratulations. Before we move forward, let's see if you can answer these questions. What are the 4 required elements of an insurance contract?
What y'all say? 4 required elements of an insurance contract. Any guesses?
Give me 1 second, just. It's I know one is consideration.
Okay.
Let me see. Hold on 1 second. Actually, man, I'm glad you brought all this back up, because I actually found all my notes and everything from class all the way up to chapter 4.
Okay. Okay, that's what I'm talking about.
Let me see. Now, gotta go back through them, brother.
Anybody else want to take a guess?
Let me see. Hold on.
Anybody else?
Let me see.
Anybody else want to take a guess?
Hold on, bro. I'm gonna get it.
They burnt out.
Okay, and then it's repeat that question one more time. What are the 4 required elements?
Yep.
Let me see. And I have it on my cell phone, so I gotta make it bigger.
So 4 required. I know it's so y'all know it got it. So it gotta be a that what you call it? I can't even think of it. But it's an agreement between the insurer and the insured.
The contract.
Contract.
Negotiation. No, it's contract. Negotiation. Well, no, it's not negotiation between the two parties because there's no negotiation between the insurer and the agent because it's either take it or leave it. So it's contract, the insurability.
Okay.
Shoot. Contract, insurability. Oh, Lord have mercy. Contract, insurability. Bro, you got me. I'm lost on the last 2.
All right, we finna go through. We're gonna look at it.
Okay.
Agreement, consideration, competent parties, legal purpose.
Agreement, consideration, competent parties, legal purpose. Okay.
I'm looking for that.
What 2 parts make up a life insurance
The 2 parts make up the life insurance application.
Part 1, general information, and Part 2, medical information. When must insurable interest exist in life insurance?
When is that? At the time of it, right?
At the time of application. How did you do? If you're unsure, you can always read through the chapter again as a refresher. Reflecting on something new that you've learned is crucial for building knowledge. Before moving on, take time to reflect upon the learning objectives for this chapter and make sure you understand all of these concepts. Recognize the specific characteristics and elements of a legal insurance contract. Identify major steps in insurance underwriting. Understand producers' duties and responsibilities. And know when a policy is considered delivered and when coverage begins. Though you might feel a little overwhelmed, make sure to give yourself a pat on the back. You're 1 step closer to passing your exam.
All right. That's chapter 1. So now if we do go to the quiz. All right, 15 questions. All right. Which of the following will be included in a policy summary? Oh, we just went through that. And this is the beautiful part. A, B, C, or D? What's y'all guess? Y'all there?
Yeah, wouldn't it be D?
Here.
I was
Yeah,
just thinking about I
D.
said D. What, girl?
D as in dog.
Yeah, D as in dog. I'm sorry. I'm
Okay. Any other guesses?
in your summary. Yeah, it actually could be now. See, it ain't no all of the above answer now. I definitely would be D. Primary, secondary, I think it's
All
C.
right.
C
We're gonna
right
go with D.
here.
Let's see what it is.
I don't care, Lola. If that's what you want to get, then get it. Oh,
And
I was right.
that is correct. And always go with your first mind,
Well, we were right.
right? Always go with that first mind. All right. Correct. Number 2. If a policy includes a free look period of at least 10 days, the buyer's guide may be delivered to the applicant no later than
At the time of the application, at the time of the premium, right?
so what
I
letter?
can't see it, Justin. I ain't got my glasses on.
Okay. A, prior to filling out an application for insurance. B, with the application. C, upon issuance of the application. Or D, within 30 days after the first premium payment was collected.
See,
C. All right. Anybody else? All right.
Yeah, I'm going with
It was
the policy.
B, with the policy. So if a life insurance policy contains a free look period of at least 10 days, the buyer's guide can be delivered with the policy. If it doesn't, the buyer guides must be delivered prior to accepting the initial premium. So it really depends on if the policy have a free look period of at least 10 days.
what was the answer? B or C?
B, with the policy.
Okay.
Mhm. All right, number 3. If an insurer issued a policy based on the application that had unanswered questions, which of the following will be true? A, the policy will be void. B, the insurer may decline coverage later because the information missing on the application. C, the policy will be interpreted as if the insurer waived its rights to have an answer on the application. Or D, the policy will be interpreted as if the insurer did not have an answer to the question.
C.
D.
Ooh, somebody said C and somebody said D. All right. Tim, what made you say C?
When I was listening to it in the presentation, it was saying that it was C. Gave cause it said that. Hold on one second. I told you I ain't got my glasses on. I can't see the answer to that question. Read C again for me. I can't.
Yeah, the
see
policy
that.
will be interpreted as if the insurer waived its rights to have an answer on the application.
Because that's what the agent or the insurer is going to determine because he didn't answer the question.
Okay. All right, Paula, what made you say D?
Yeah. Okay, the policy will be interpreted as if the insurer did not have the answer for that question. And then it's not really, they can't go, continue with the policy. You have to go back and have them to answer it again. Because my stuff is different from in chapter 1. Texas is not, I'm trying to find that question on here. Hold on.
Yeah, if you can go to the book and look at that one.
Yeah, because this one here, the questions is all for Texas stuff. And that's a little bit different.
You said it's different.
What's the correct answer?
It would be C.
C of the policy will be, okay,
Let me do this. So if we
let me find.
go to Primerica,
Yeah, 'cause I remember in that presentation that what it said. I said I had heard it in that presentation where it says it's gonna be like the buyer basically I guess basically omitted the answer, didn't have the answer, something like that.
we're gonna check that out.
I was just, at first it was as if they didn't finish finish the question, then the policy is still none and void. That's what I understood to be. Yeah.
So if we go to Texas and we look at that question, that was
What was it under the?
what was the question asking? What was it saying? If they didn't have to answer the question, right?
If they didn't answer something on there, would it be considered?
Okay.
Am I saying that right, guys?
Yeah. Now we just want to make sure that this is correct. Because I remember seeing it like right in this, okay, consequences of incomplete application. Before application is issued, all of the questions on the application must be answered. The insurer receive an incomplete application, the insurer must return it to the application for completion. If a policy is issued with questions left unanswered, the contract will be interpreted as if the insurer waived its rights to have answer to the question. Yeah, so it's the same.
That's the same what I was saying.
No, if they didn't answer the question, then they automatically assuming that the insurer, which is the company, waived that question. They don't have to answer it. So I just wanted to make sure, so we ain't sending, Louisiana and Texas off with Illinois. So that's good that you on here, because now you're gonna get that question right. All right.
The right answer was C.
Right. They waived it.
Okay, it was a waive.
The Gramm-Leach-Bliley Act was passed to allow insurance companies access to medical information for underwriting purposes. B, protect private customer and information filed with the financial institution. C, define insurance as in interstate commerce. Or D, allow consumers access to credit and private consumer reports. Which one y'all going with?
B.
Yeah, I don't even know.
Let me look at this. My 4 is different.
Huh? No, oh no, it's not gonna be the same questions.
Okay. Well, that's what I was looking for. Oh, okay. Mm-mm.
And let me see, I can make this a little bigger too. There we go. So B, we going with B?
To protect the private.
That's what I say.
Yeah, I couldn't even say if that was right or wrong.
Insurance company. Hold on, let me read it all again. Okay, I would say B as well, as far as looking at it,
Correct.
but
Correct.
that's not
Correct.
on
Correct.
that.
All right. Number 5. Who might receive dividends from a mutual insurance? Hmm.
Who might receive dividends from a mutual insurer?
We
The
just talked.
policyholder.
A.
I said A. I said
Yeah,
A.
policy holder. Yeah.
Yeah. That's we extensively went over that one. All right. The Federal Fair Credit Reporting Act. What they do?
They regulate, make sure there's no money laundering.
C. BC.
Okay. See. Correct. So let's read this one. The Federal Fair Credit Reporting Act regulates consumer reports, also known as consumer investigative reports or credit reports. All right. Number 7, insurance policies are not drawn up through negotiations. You just said that, Tim. And an insured has little to say about its provisions. What contract characteristic does this describe? It's a good question.
I said the insurance policy does not draw up through negotiation.
Unilateral. A.
Okay. What you going with, Paula?
Let me see. Yeah, D. I'm just guessing.
Okay. Adhesion. And then you said A. It's between one of them. Let's go with A because Tim said that one first. And it is D.
It's the adhesion.
Yeah, you got that one right, Paula.
Awesome. That'll work. Good.
A contract of adhesion is prepared by only the insurer. The insured only option is to accept or reject the policy as if it is written. That is good. So then what is unilateral? Daggum. Would they show us what that is?
Unilateral?
Because that's good to, if we go to, let me see, go back to the private one and go to unilateral. I think that was at top, wasn't it? Nah, this gotta go down. Let's see, where is unilateral? Now I gotta be way at the top. Yeah, here we go. Here we go. All right. Dang, I just seen it. There you go. Unilateral contract. Only one party is bound to do anything, legally bound to do anything. Unilateral.
Only one party is bound to do anything?
Mm-hmm. Yep. So that's what that is.
So that's if the person that, like the beneficiary, somebody that when the party is passed,
Yeah, so an example is like when the insured let their policy lapse. In that scenario, the insured is, I mean, the insurance company, the insurer is not obligated to like no. If the insured is paying a premium and die, the
Right.
insurance company can't renege.
They have to pay
They gotta
first
pay.
value
Right.
on it.
Right. That's what that is.
So the person that they left it to. It's like
Right.
unilateral. But they got you. I'm not saying it right.
Yep. Unilateral.
Mhm.
All right. Next question. The Medical Information Bureau was created to protect what?
Could you make that a little bigger so I can see it?
Medical Information Bureau. I just looked at that.
See,
Okay. Medical examiners that perform insurance for physical examinations. What do you say, Paula?
Hold on. Okay, I would go with D.
And I actually think it is D. I think
Because
it's D. Let's try.
they have
Yep.
to sure. Yeah. Okay.
The MBS, I mean, I'm thinking about Money Business Seminar. The MIB makes information available to underwriters to assist them in the underwriting process. It is a nonprofit trade organization which receives adverse medical information from insurance companies and maintains confidential medical impairment information on individuals. Yep. That will be D. All right, number 9. Which of the following information about the applicant is not included in the general information section of the application for insurance?
Between A and B's, I'm gonna say A.
Okay. Not included in the general information.
Okay,
Now
I'll go with A.
Okay, so both of y'all say A.
Mm-hmm.
Now keep in mind the general information is all about them, minus the
B,
medical.
B. It's B.
Right?
It's B.
You said B as in boy?
Yeah.
Okay. What does the insurance policies make up? General information, and then what's the other part of it?
General information. Let me see. Well, take that back, brother. You laid it out. D as in dog.
There we go.
Oh, okay.
Right, medical background. They not asking any medical background in the general information because the medical background is its own section.
Oh, okay, I see now.
All right, number 10. Representations are written or oral statements made by the application that are, oh, this one easy. Which one y'all say this one is?
A.
Okay.
D.
Okay. Tim. Tim, you still reading it?
Trying to focus on my eyes, bro. I'm trying to get ready for work and then focus on my eyes because I don't have my glasses on.
Oh, no worries, no worries. All right, so representations are written or oral statements made by the applicant that are, and Paula said D, considered true.
D.
Yep. Remember, warranties are like guarantees.
Mm-hmm.
Representations is just to the best of their
ability.
Right. All right. Under the Fair Credit Reporting Act, individuals rejected for insurance due to information contained in the consumer report, A, must be informed of the source of the report. B, are entitled to obtain a copy of the report from the party who ordered it. C, must be advised that a copy of the report is available to anyone who requests it. D, may sue the reporting agency in order to get inaccurate data corrected. So we know off the bat, C and D may not be true.
I'll say B. So they entitled to get it once, the decision is made.
Right, right.
So they're entitled to get a copy
Well,
of the report.
Okay, that's good. What you going with, Tim?
B.
B? Okay. All right. I'm going to actually say A, must be informed of the source of the report.
Mm-hmm.
Because if you said something wrong about me, I want to know who told you that.
That's
right? True. So I'm gonna go ahead and help y'all with that one. That one is A.
Okay. Must be informed.
Yep, of the source of the report, because you're not entitled to obtain a copy of the report from the party who ordered. Primerica ain't gonna give you the report that they got. You got to call the source. They got to tell you who they got the report from.
Well, can it be a two-part answer?
It could be a little tricky. Just know if Primerica gets the report from you, and that's why they declined you, they're not obligated to give you that report. They obligated to give you the source where it came from.
Okay.
All right, 3 more. If only one party to an insurance contract has made a legally enforceable promise, what kind of contract is it? So we can just play process of elimination. Do y'all think it's C?
Mm-mm.
All right, so we X out C. What about D? A legal but unethical contract?
No, I'll go with B.
Okay, B, adhesion. Now you got that question right before with the
I'm gonna say A.
A.
Hey, yeah, because that goes back to that one person.
Right. Exactly. That's good. All right, two more. All of the following are duties and responsibilities of producer at the time of the application, except change any incorrect statement on the application by personally initialing next to the corrected statement. Well, let's play process of elimination. Can the agent do that?
No,
Change any incorrect statement on the application by personally initialing next to the corrected statement. So you said no on that one. What about B? Explain the nature and type of receipt the producer is given to the applicant. Is that true? They got to explain that to the consumer.
but they still have to explain what the
Yeah, they
person
still
is
gotta
signing.
explain.
Okay,
Yeah.
so we can cross that out. And remember, it says except. So if they got to explain, that means we cross out B. What about C?
C. I'm gonna go with C.
Okay, probe beyond the stated questions if the producer feels the applicant is misrepresenting or concealing information. So that's, you would say that's not agent's responsibility?
That's the agent's responsibility.
Yeah, that's the agent responsibility to
Yeah,
go
'cause
beyond.
they the first person that see
Right.
the client.
Okay, so that means that's true. So we cross that out, right? Because if you tell me you don't smoke cigarettes and I'm looking dead at you smoking a cigarette, it's like, hold on now, wait a minute. Now, come on now, I'm looking dead at you. What's that in your mouth, right? What about D? Check to make sure that there are no unanswered questions on the application. Do they have to do that too?
Yes.
But the agent, yes.
All right. So what does that mean? What answer that leaves us with?
Was it A?
A, ain't that what you said, Paula?
I don't know. We done said so much.
Look, it's A.
Change any corrected statement.
The agent cannot personally initial next to the corrected statement. That is the insured job or the applicant job.
Yeah, because they the one that initialed it. So if they mark something wrong, and so I did that wrong, and they slash it out, and then they put their initial on it because they changed it. Wouldn't it be?
Right.
But actually, if you're doing it online, it's gonna be different anyway.
Right.
That's for paper.
Right. But it still can apply if you have to change that, because I had to do that one day. Unfortunately, it was brutal. It wasn't that bad. It was old school. So all right, number 14. Which of the following is a risk classification used by underwriters for life insurance? A, poor, B, normal, C, excellent, D, standard.
D.
Yep. 3 levels are standard, substandard, and preferred. That's good. Last question. If a change needs to be made to the application for insurance, the agent may do all of the following except, that means any true answer is wrong in this scenario, which is weird, but it said that's because of the word except. Erase the incorrect answer and record the correct answer. Can they do that?
No.
Okay. Draw a line through the first answer, record the correct answer, and have the applicant initially. Do they do that?
Yes.
Yeah, the answer is B.
According to that other one.
Okay. Now, Tim, keep in mind, it says, what does the agent may do all of the following except?
Oh, okay.
See that? Yeah, so B is not the answer, but it's true. And it's not the answer because it's true. So B is crossed out. C, note on the application the reason for the change.
Oh, so you say the agent accept? Well, it's D. He can't destroy the application.
Destroy the application and complete a new one.
Say that's what you can't do, right?
They can do. They can.
Destroy the
main-
application.
No,
So
you're not supposed to destroy the application. You're supposed to set and make the changes or whatever and follow the changes, or be able to create a new one, let the other one lapse and create a new one, right?
partially right. I mean, 3/4 of it. They don't have to let it lapse and then do it again. They just they do have to change it. But to destroy the application and complete a new one, I've never had to do nothing like that. I've never seen that.
All right.
And then erase the incorrect answer and record the correct answer.
We're not
Yeah.
supposed to erase anything.
Ooh, did it say that?
It said you can put a line.
But we
through
ain't
it.
supposed to. We're not supposed to white out. We're not supposed to white out or something. We're not supposed to erase or white out.
Uh-oh. So then is the answer A or D? Because one of them is not true. It's a good one.
I think it's B.
That's why I say, am I correct? We're not supposed to erase or white out. Am I correct or am I wrong?
Right, but see on the B, you just drawing a line through it, and then the person initial it.
I thought that's what I said at first was B.
You did.
That's the true answer. So the true answer is not the right answer in this scenario.
Okay.
So B is incorrect because it's not accept. The
Okay.
agent can do that. So
Okay.
can the agent erase the answer, incorrect answer, and record the correct answer?
No.
Okay. Can the agent destroy the application and complete a new one?
No.
Actually, they can. You can do that.
Really?
Just redo
Yeah.
it. Just
I like
redo
that
it.
in that presentation.
Huh?
I ain't hear nothing about that in that presentation.
Right. Well, we don't have to do it because it's electronic. But if I made too messed up of a mistake, like as far as on paper, yeah.
Oh.
But and I first off, we got to do the application in pen, right? So we gonna go with A. Let's see what it's talking about, and that was right. That was right.
The answer was A.
The
Okay.
answer was A. You are not supposed to erase incorrect answer. You said it. You can't erase. You can't white out. See, now if you didn't have said that, I probably would have went with D, just going fast. But because you said that, I'm like, hold on, let me slow down. Because if I messed up an application, I easily throw that application away, shred it, and then get a new application. You can do that. Who said you can't do that, right?
I got you.
So that's good. All right, let's look what we get. We got 86.
But how many questions supposed to be on there? They say it's 2 hours long.
No, this was a chapter quiz.
That was a chapter quiz. Yeah.
So we got to do 6 chapters.
Right.
All 6.
Yep. So here's the thing. So now we just went through chapter 1. Now what I want y'all to do, Tim, this probably be real easy for you to do this evening because you going to work. Take that chapter quiz 3 times consecutively and pass. You gotta pass it.
Well, I can't get on it because of my password.
You might be able to call them tonight. Yeah, you might be able to call them tonight. And matter of fact, try to log in from the website primericaonline.com instead of the app.
Oh,
That's
my
what.
God, look, we can have
Yeah.
our laptops, and then my job, like I said, is high security. They don't even let you get on the internet. The only thing you can check on the internet is the news.
Oh, got you. Okay, so you can't do it at work. Okay, cool. Well, tomorrow when you
When I get home, yeah, tomorrow I'm gonna try to get my password, but I'm gonna try to take that, like you say, take it 3 times. So I'm gonna take the
yeah,
practice exam, right?
huh?
You talking about take the practice exam, the one what we just did?
Yep, the practice quiz,
Okay.
chapter quiz. So yep. So please, y'all let's not let this go in vain, right? Look, somebody just passed a life license. Dadgummit. So let's really get aggressive with this. All right. Now it's y'all two on here. So here's the thing. If y'all will go through chapter 2 on y'all own, we can actually just go straight to the chapter quiz, right? Because it was a lot of material. And I'm gonna look at it and see if there's some stuff that we can just kind of bypass a little bit. But for the most part, was this helpful?
Very helpful.
That's good. Paula, was it helpful for you?
Yes, it was helpful. So because I have like the quiz, the chapter 1, I got all of them. I just kind of printed them out. So you saying go through it 3 times?
The chapter quiz. Yep. Take it 3 times and pass it 3 times. That lets you know that chapter. Here's the thing. If you pass each chapter 3 times, that's 15 questions each. That's a total of 45 questions that you took for each chapter. And you pass them. When you take that practice test, it's a breeze. There is a 98% pass ratio when you pass all 3 chapter quizzes consecutively, back to back to back. 98%. That is very, 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 very high.
Okay.
So if you want to pass this silly exam, and you only got to pass it with a D, a 70%, but if you commit to passing those chapter quizzes 3 times consecutively before moving on to the next chapter, it's impossible for you to fail this test. The only way you fail the test is you failed in your mind and messed yourself up.
I got you. Yeah, overthinking.
Right. So y'all see what we just did? Now, we went through this. It took us about 2.5 hours. That's because it was multiple people on. However, if you're going through it by yourself, it probably take you an hour and a half. Right? All you got to do is do that 6 times. That's it. Do it 6 times. So we bit the bullet today, right? We put that work in. Now y'all got to do it 5 more times. Paula, do it before your exam. You actually scheduled your exam. That's a big deal. That's another thing. We Tim, we got to schedule your exam. We got to make sure it hasn't been a year. We got to schedule that exam. That's when it becomes real and official. When you put the money up and you say, okay, I'm going to take this test, right? And you put the money up that's reimbursable because the company going to pay you back when you pass. That's when you know that it's real.
Okay.
It is not real when you just study it. When you put your money where your mouth is, that's when it get real. That's when to be honest, that's when I got my securities license. I just ended up, I scheduled the test like, all right, I'm gonna take it this day, I'm gonna take it that day. And actually, I believe that I scheduled my exam too close to each other. But guess what? Because I scheduled it and I did not push back, I'm like, nope, I'm gonna get it done. Boom, boom, boom. Guess what happened? I ended up passing both of them.
That's what's up.
So that's what I'm gonna do with everybody. So that's y'all homework assignment. Please go through pass that quiz 3 times consecutively, and I want y'all to put that in the chat. right? Hey, I just passed the chapter quiz 3 times consecutively on to chapter 2, and let's make it a challenge. We should next Friday. This should be a done deal. We should not be doing this no more. I should be working with the next bunch.
Sounds like a winner, brother.
All right. Hey, I'm excited for y'all. I appreciate y'all for being on. Look, we're going to go ahead and get this out the way. You get your license. You get paid one time. You're going to understand why we put so much emphasis on getting the life license. I'm telling y'all. Y'all will see.
Yeah, I'm about ready to fire my boss because I'm ready to do something, man. Where I ain't got to work hard.
Right.
I did that all my life. Yeah.
Yeah. So this is a process now. Now y'all can study on y'all study quicker or whatnot. Where you do 1 chapter a day. Weekends is probably real good because it took about 2 hours. So if you did 2 hours in the morning time or something like that, or in the afternoon, and then another 2 hours in the evening, oh man, you halfway done right there. We did chapter 1, then you do chapter 2 and chapter 3. You done. You halfway done. You halfway there.
I got you.
Yep.
Oh, yeah.
So it's that simple, y'all. So I'm excited, very, very excited. I'm gonna be talking with the licensing coaches, and I'm gonna ask them, is there any guidance they can give me so we can get it better? Maybe we don't have to go through the whole chapter the way we did today. It worked. It was a lot of time, but I'm gonna ask them, talk with them, and see is there any other avenues for people that's brand new, that's taking the class. So once they go to class, it's like it's a breeze for them. And I'm gonna find that out. We're going to produce the most licenses. Now, right now, we're down to a team that has about maybe 4 so far. I think we'll beat them out because they ain't doing what we doing right here. And we got some highly qualified, highly sharp people. So I'm excited. So that's all I got, y'all.
All right, my brother.
Well,
y'all
thank
have
you very much for
you
helping us.
welcome. You
All
welcome.
right,
Y'all
my
have
sister. Thank you so much, Jake.
Yep. Y'all have a blessed evening. Tomorrow morning, we do got training 9 a.m. 9 a.m. So, hey, y'all be in tune with it. Let's be plugged in. 50% of winning in this business is just showing up. Most people won't even show up, y'all.
I got you, brother. All right.
All right. And then go on the
time?
chat. Go on the chat, y'all. Y'all talk about the real quick on the ACES group and just talk about how what was the experience with this so we could get some more people on.
All right, I'm gonna do that once I get settled in. I'm gonna go on the chat.
Okay, I appreciate it. All right, y'all have a good one. Y'all have a blessed